Welcome everyone. We're joined today by Tony Steels and Will Wilkins, CEO and CFO of Mpac Group, who have just announced another trading update on the back of 4 months where they have successfully ridden out the COVID situation. Tony, thanks for joining us. Let's start off with a review of how you and Mpac have responded to the COVID situation. Can you give us an overview of the steps and measures you put in place?
Yeah, sure. Well, I first of all say that I believe we've had a really resilient performance over the last 6 months. I'm delighted with the response of our colleagues and how they've stepped up in the face of this unprecedented pandemic. And I think we're in very good shape for a fast recovery. And there's 3 areas we really focused on. The first thing was the rapid assessment of the situation. The second area was adapting very quickly to the situation and trying to leverage the digital platforms that we had in place, and then moving on to a sort of fast recovery. So if I think we talk first of all about the rapid assessment of the situation, the first and primary thing for us was the health and the well-being of all our employees and their families. So we wanted to put in place measures very effectively and quickly, which we did. All the businesses stepped up to create a very safe working environment, and that resulted in approximately 40% of our people working from home. We did furlough a number of people, around 20% of our people, and that was to create that safe environment so the employees felt safe in the working environment, or if they were in a vulnerable category, they were able to self-isolate without any pressure, if you like, from the work environment. Communication was the key. We wanted to maintain business as normal as best we could with the customers, so communicating with our employees, to give them clarity and consistency of what was happening, because there's an awful lot of mixed messages. Bearing in mind we're a global company operating in the UK, in Canada and the Netherlands mainly. So there's 3 different governments, and interpreting the different rules and trying to get a consistent message across the business was key. Communicating with our customers also key, to ensure that they knew we were still there to support them, because we are very much attached to the essential supply of food, beverage and healthcare products. And then the final thing was the liquidity protection measures, which we'll talk about more later in this presentation. We really wanted to ensure that we had the business in the best shape to withstand however long this pandemic continues and the business disruption continues.
So then, in which case, the last 4 months has all been about taking an opportunity to streamline the business, never let a good crisis go to waste?
That's one way of putting it. We really did focus in the initial period on obviously cost-saving measures and the liquidity protection, if you like, of the business to make sure we're in good shape. We have got a very robust balance sheet. As I say, we'll talk about that later. But then it was for us more about ensuring that our customers knew we were there and leveraging the new technology. We've had video conferencing for a couple of years, so that's seen a 10-fold increase, and that's really to keep in touch with our customers, to keep communicating, to maintain the customer service levels. So during this period, we have seen a reduction in revenue, albeit we've kept the businesses all operational, but the revenue is down around 25% from our expectations. But we've seen no orders cancelled, and we've been in the fortunate position to win new business during this period in the COVID-related space, as I'll term it. And that's mainly coming from the USA. That's quite a strong market still in the USA, and particularly in the healthcare side of that market, albeit EMEA and Asia have had a tougher time over that period.
Ongoing crisis in the US isn't having increasingly negative impact on those orders and interest?
No, it's remarkable, really. But with the news flow that we hear about the US and the situation there, when we talk to our people on the ground, it doesn't seem quite the same as we're normally hearing on the news. People are moving around in the US. We do have a business in Canada, as you're aware, and the cross-border travel is still problematic in terms of the Canadians need 14 days self-isolation when they return home. But the US market has remained strong, and we're seeing a good business uptick in the COVID-related space. Now, what's the COVID-related space? We're not particularly into hand sanitizer and face masks. You know, they are not products that we were involved in previously, but we are involved in hygiene-related products, and that can go from refuge bags, so household hygiene, we've seen an uptick in demand, on the other end of the spectrum, to point-of-use drug testing. So there's an awful lot of different pharmaceutical and healthcare companies supporting the work towards vaccines and drug testing, also COVID antibody testing, and we're involved in a number of projects to support that. So we've seen that primarily in the US market and to a lesser extent in the European market.
Okay then, so going forward, do you think there's an opportunity to gain a little competitive advantage? I know you spoke in the statement about when travel restrictions are eased, you will be able to hopefully secure more orders as you can and do more business as you can see more people. What happens if that's delayed? Will that have an ongoing negative impact?
Well, you're absolutely right in your assessment. You know, we don't know the length and the depth of the pandemic and the impact on customer demand. So, as you know, we've withdrawn the forecast. We hope to reinstate that in September with our full half-year update, as it were. But, you know, at this moment in time, we're focusing on the situation as we see it. And we've got, you know, the agility and the ingenuity of our employees has been remarkable. We're more or less 100% now doing factory acceptance tests virtually. That means our customers are approving the equipment for shipment before it leaves the factory using virtual reality and video sessions. So that's become the new norm. We've invested pre-COVID in new websites so that we've got a much better, if you like, online presence. We just completed our first virtual exhibition. We had a live event last week, which was very well attended. We had several hundred customers dialing into a series of one-hour events to talk to our experts about their technology needs going forward. You know, there's a number of areas where the businesses have really stepped up and embraced the digital technology with a real focus on customer service and driving it. So I think we're in a very, very good position to withstand the headwinds for a number of months going forward and to be in pole position for a fast recovery when the market demand starts to return. As I said earlier, we're still winning business. You know, we looked through our prospects pipeline recently, and 75% of our prospects in future prospects are around essential foods and healthcare products. So when you look at the different demands within the packaging machinery world, we feel we're very well positioned to be, you know, to come out of this crisis even stronger.
Food and medicine, not requirements that disappear with the pandemic.
Absolutely.
Thank you very much.
Thank you, Hannah. Appreciate it.
Will, taking a closer look at the financials then, 4 months seems a lifetime ago. Can you remind us, what position was Mpac's financials in before we went into this situation?
Sure. Well, Mpac entered the coronavirus crisis with a very clean and well-managed balance sheet. So we were in a positive position in that regard. And to provide some context, we're not a capital-intensive business. Most of our balance sheet items are associated with project execution. We're also in a favourable position in that we are and continue to be debt-free, with the exception of preference shares, and we have access to a 10 million committed bank facility agreement. So all in all, we entered the crisis in a good position and with a very strong balance sheet.
Obviously, quick reactions to this type of situation is what required. So what steps were Mpac able to put in place?
Sure. Well, at the very beginning of this crisis, in early March, the management team got together and carried out a review of the steps and actions that were needed to mitigate the risks of the impact of the coronavirus. So the first step was to place cash and working capital under close monitoring. We performed a deep review of the spending plans across the group, looking at all discretionary spend, opportunities to defer that, and also placed a freeze on recruitment. So that was very much focused on immediate cash protection and spend. Looking at our capital investment profiles, we wanted to ring fence investment in new product development because that's critical to the ongoing success of the group, and some strategic projects associated with business systems implementation. But aside from those key areas, we've put a freeze on capital investment. Alongside that, the board and senior management for a fixed period of time have taken a pay cut to help mitigate the cost base of the group. And we've ensured we have accessed government and state support in both the UK, Canada and the Netherlands actually. And at its peak, we had approximately 50% of our UK employee base furloughs accessing the government job retention scheme to ensure the minimal impact on our employee base as a result of this crisis. The immediate action in terms of cash management then moved on to managing our debtor days outstanding. We've historically been running at somewhere between 60 and 70 days on average, but with clear focus and dedication to that part of the balance sheet, we've managed to bring that down to mid-50s during this crisis by focusing on minimising the collection period for all of our sales ledger balances.
So strong and comfortable cash position going forward.
Yeah, we've got, we remain debt-free, as I mentioned. We've got, at the end of June, a cash balance of circa 23 million. So that cash profile in the first half of the year was very much in line with management expectations pre-crisis. So in terms of our cash generation, actually, the measures we've taken have ensured that there hasn't been an impact on our cash position in the first half of the year. If you look at our cost base in relation to the cash balance, we've got approximately 1.5 years coverage of our indirect costs, so a good level of protection, a clear runway ahead of us. And those measures and those actions to protect the balance sheets have left us in as good a position as possible to recover once the market returns to normalised trading activity levels.
Fantastic. Well, thank you for joining us, Will, and we'll look forward to hearing a little more in September with your next results.
Thank you.